As we all know, there is much to be done. Earlier this week, I was talking to a small business, a tennis academy that has survived the pandemic and is now thriving. However, when the owner, Carmen, was telling me about her capital needs, I asked her if she had reached out to a mission-based lender or a Cdfi. Her answer was that she thought microlending was only available internationally, and she assumed her only options were a bank or friends and family. I believe that the silver lining of this pandemic is how our industry is no longer the best kept secret. But similar to Carmen, many diverse entrepreneurs are still not aware about the entirety of their financing options and the COVID relief options that exist or how to navigate them. During the pandemic, businesses owned by women and people of color were disproportionately impacted by the lack of access to PPP loans. For example, just 12% of Black and Latino-owned businesses received the full funding they needed, and more than 40% of Black-owned businesses shut down in the early months of the pandemic, compared with 34% overall. Cdfis work tirelessly to fill in these vast gaps in PPP lending, outperforming traditional banks and reaching financially underserved businesses often left behind by the financial system. During our listening sessions, member Cdfis have shared innovative ways of how to reach those businesses left behind. We have seen how our lenders are able to reach entrepreneurs where they are, while continually improving their internal processes to further incorporate racial equity and inclusion into their operations. Cdfis are listening and taking action about what needs to be changed to make sure that a Hispanic or a Black business owner's voice is heard, their loan application is fairly processed, and their business is funded. We are humbled every day by the impactful work you, our members, have done to work with the small businesses, going the extra mile to make sure all entrepreneurs have access to the capital that they need, like helping with their financials or in smaller ways like document scanning, digital training, and translating. The time and effort you have put into California's and the rest of the country's small business communities is awe-inspiring. Cameo's annual MicroLenders Forum has been a space for our members Cdfis to connect and learn for the past 12 years. Today, we bring to you a rockstar lineup of speakers from both the national and state stage. We will share with you more about our Cdfi Incubator, and we made sure to leave time for you all to connect with your colleagues to discuss what inclusive small and micro business lending looks like in the new reality post-pandemic. So with that, let's get to it. It is my distinct pleasure to welcome back to California our first speaker, Isabella Casillas Guzman. She was sworn in as the 27th Administrator of the U.S. Small Business Administration on March 17, 2021. She serves as the voice for America's 30 million small businesses and innovative startups in President Biden's cabinet. Administrator Guzman grew up in a small business family and has been an entrepreneur herself. She has spent her entire career advising entrepreneurs, launching ventures, helping small businesses navigate government, and creating policies and programs to help advance entrepreneurship and innovation. Many of us know Administrator Guzman from her work as director of the California Office of the Small Business Advocate, where she helped small businesses and innovative startups in the world's fifth largest economy start, expand, and grow. She advocated firstly for financial relief for small businesses and focused on expanding assistance to entrepreneurs in underserved communities. In addition, she served as the Economic Recovery Support Function Coordinator for the state, where she spearheaded the small business recovery effort during the COVID-19 pandemic. So without further ado, let you with Administrator Isabella Guzman. Isabella, Administrator.
Hi, thank you so much, Carolina, for that introduction. And it's great to see some familiar faces from California. So pleased to be able to join you. And I'm really glad that my team can join a little bit later as well. I know that Cameo was such a critical partner for me in sharing insights and truly leading for impact. And your incredible members as well. I know many of you in your work, you do have such an important impact and actually lead and show best practices to lead the nation as well. So I really, I'm pleased to be here with you, and I know that you'll have great conversations later in the day, and you'll continue to circle back with us and be a good partner with the SBA as we look to really uplift our small businesses across the country. I know that I was reading recently, of course, about your recent work providing critically needed technical assistance to our aspiring lenders and really trying to expand your footprint across the nation in serving our lenders that have become, as we know, so important and critical during COVID, especially to SBA's network as well. And glad to see that SBA is supporting Cameo through Prime and through the Prime Grant Program, the program for investment in our micro entrepreneurs. And many of you know from my days in California that I prioritized leveraging technology and increasing digital adoption across our small businesses. And so very pleased to see that Cameo has focused on making sure that digital adoption, digital fluency, as well as the cultural and language accessibility are embedded in the technical assistance that you'll be providing so many of our small businesses. I'm excited to learn today that you're also going to be announcing the expansion of your Cdfi Incubator. It does offer critical training to help those microlenders, which we know need that additional technical assistance, need that team around them as well, to expand their footprint and their impact in their communities. So I do look forward to seeing some positive outcomes from the Prime Grants and Cameo's work in that space. I don't need to tell all of you how challenging the past 19 months now have been. As we've been facing, basically being on the front lines of the economic crisis and facing COVID together. I mean, it's been panicked phone calls that I know you've all received from small businesses as they've tried to navigate resources and figure out how they were going to keep their doors open, assuming more debt, wondering how they were going to still be able to keep their employees on board or keep their doors open during this time. And I know that many of you have worked really hard to help them find those solutions and have worked alongside my wonderful colleagues at the SBA as well. And I hope that that work has been rewarding for you. And I just wanted to make sure that I also thanked you personally just for the work that you've done. I think that too often we don't stop and pause to just really reflect on how fast we've been running over the past 19 months, and I know all of you have, and I see it from the national scope as well these days, and just really impressed by the tireless dedication that you all have. And I think, going beyond just the normal support to small businesses, but really rally enthusiasm and support for small businesses through your networks, the corporate and philanthropic partners and supporters that you have, as well as through local and states and federal governments, just making sure that the impact on small businesses by COVID is offset with great support and relief. And I think that work should be applauded as well. I know that I wish I could say that the pandemic is over, and I know that we're still in these tough times in terms of really helping support our small businesses as we continue to battle the Delta variant and see consumer behaviors again changing. But with these challenges, we're going to definitely need to continue to lean on you for that support, for your ability to deliver financial lifelines to help so many of our small businesses reopen and survive during this time. I'm sure that you're likely seeing that as well, that there's on the other side of that, besides our hard-hit industries that have been truly impacted by COVID and seen their revenues drop, we also are seeing incredible rates of entrepreneurship. I mean, in the first 6 months of this year, we had 3 million entrepreneurs applying to open new businesses, which is a 60% increase over the previous year, which was already off the charts and really high in terms of entrepreneurial activity. So we're seeing it on multiple fronts, the hard-hit industries as well as these new startups that are trying to make jobs for themselves, perhaps, or pursue opportunities that they've seen during this time. So I know that you're very inundated and needing so much more support and continued rallying to try to support our small businesses, especially our smallest of the small. And so I know that relief is critical, but we're also wanting to make sure that we can help those businesses with that next great idea or business plan, and as we look to build back better. I mean, that's what the agenda that President Biden has laid out is all about, is reimagining our economy, identifying opportunities so that we can make sure that all of our businesses, small businesses, can succeed and thrive. And that's where the SBA obviously is core mission is set, and we want to make sure that we can partner with organizations like Cameo to help this economic recovery move along smoothly. Of course, we've seen some great results with the administration and the efforts that we've made so far. The strongest economic growth rate in over 40 years, and really strong employment, 4 million new jobs in the first 6 months of the President Biden's tenure, the most of any presidential tenure that's ever been achieved before in history. So it's lots of accomplishments, but we really have a continued drive to make sure that we can implement an economic plan that continues to have impact, especially in our underserved communities. The American Rescue Plan, which many of you, of course, are familiar with the programs that it funded for small businesses. That was a $1.9 trillion investment in public health, which of course is important for our small businesses and the economy. And it really, we went from 5% to 77% vaccination rates. $60 billion additionally was poured in to support financial relief for our small businesses through PPP and COVID EIDL and other grant programs for high impact industries. And so all of this forward thinking has been what has helped position our economy. But there's lots of work that remains. And at the SBA, we've been able to scale dramatically, typically putting out 40 billion in output a year. We've now scaled to deliver more than $1 trillion in COVID emergency relief to millions of American small businesses over the past 19 months. And so we've really scaled up to become the first responders to this economic crisis and helping our small businesses. And it's from that vantage point that we want to keep on driving hard to do more, especially as millions of our small businesses continue to struggle with the Delta variant and particularly in those underserved communities that we know had disproportionate impacts. The Build Back Better agenda, as Vice President Harris has said, is about addressing the flaws and fissures that we've seen in our economy as a result of COVID, which we all knew were there pre-existing, but really have been exposed. And we all know, especially in California, that diversity is really driving entrepreneurship. The face of entrepreneurship is changing. And so it's up to us really, if we are going to build back better, we need to fill those capital gaps and those opportunity gaps so that all of our entrepreneurs with great ideas from everywhere and anywhere, as the president says, can be supported to thrive. And I've asked my team to be as entrepreneurial as the small businesses we serve. And really that means, in this case, pivoting and adapting to serve our small businesses better, to meet them where they are, and make sure that we can transform our programs as we're contemplating design or revamping programs or designing implementation outreach. Just make sure that they're simpler, faster, and easier to use. And that's really been the guiding force. And in the past 6 months, we've designed 6 new programs, some within the American Rescue Plan, like the Restaurant Revitalization Fund and others. We've retooled 6 more, really with the overall charge of being customer-centric in all that facets that are included in that, and technology forward and equitable. And we're just getting started with all of that, but we still have $150 billion remaining in relief. And so if we're talking about our relief programs, it's critical to know that the SBA still has programs that can support our small businesses. In fact, COVID EIDL and the related advanced grant programs are recently highlighted by President Biden as he doubled down with a bold new slate of economic and public health measures to try to help us address COVID-19 and put an end to this pandemic. And that's all about boosting those vaccination rates and keeping our schools and our economy open. COVID idle, of course, was increased. The lending caps at 2 million, but importantly, especially for our smallest entities, is that we wanted to make sure that they were able to access those dollars first, and so kept a window of opportunity through October 8th for smaller entities to continue to apply for those economic injury, disaster loans, those who have been impacted, and the related grants that are available. We've put over $5 billion in grants available through the advanced programs, the targeted advance and the supplemental targeted advance programs to low-income communities. And we want to continue to get those funds out the door over the next few months as businesses still try to come back. Some of the key changes we made, and this is about meeting businesses where they are, is that we've allowed businesses to use idle funds to repay debt. Commercial debt, that's prepayment of commercial debt, and that's game changer for businesses who've had to take on some high credit cost or high cost of credit over the last few months to survive. And so this gives them the flexibility to do that with 24 months of deferred payments. And so that is how we're designing programs to make sure we're meeting businesses where they are, that they can survive and thrive into the future. And I know that you all get that in terms of knowing that especially our smallest and underserved businesses have been facing challenges historically and may not be in the same economic situation to be able to qualify for credit. And so the SBA is about filling those gaps. And also on the PPP program, we want to deliver against the promise of forgiveness. In 2021, the Biden-Harris administration really doubled down on making sure that PPP got into the hands of those smallest businesses, and 96% of PPP loans in 2021 went to businesses under 20 employees and in rural and low-income areas. In fact, we just got lauded by the GAO for that performance and being able to bring equity to the PPP program. And so forgiveness, for the forgiveness model, we launched a direct portal that businesses with $150,000 and under PPP loans could apply for expedited forgiveness. There's a simple technology that we deployed that takes less than 10 minutes to finalize the forgiveness. And so we really want to make sure that we're helping our small businesses access that final forgiveness and close that PPP loan. And not only that, but get all that capital back into the market. PPP was, of course, nearly $800 billion. So far, we've forgiven 7 million loans and $553 billion worth of PPP loans, putting that money back to work in the economy. And as we move forward, we are committed to making sure that all of our portfolio and our distribution network and our outreach partners can be transformed to better serve today's entrepreneurs, which is why insights from groups like you and our continued partnership is really so critical. We want to make sure that all businesses can access capital and that they can recover or take advantage of the great opportunities that are laid out in the bipartisan infrastructure deal or in the Build Back Better reconciliation bill. There are opportunities for businesses to grow their revenues, but they're going to need the capital to do that. So we're trying to position our programs to make sure that they can continue to be, small businesses can continue to be those job creators, producing strong economic output for the nation. And there has been, of course, a vast market failure, especially on small dollar loans. So we're excited that within the reconciliation bill, there's some progressive new programs for the SBA to deploy. And so we're tracking that closely, as hopefully you all as well. We want to be a bridge between our smallest businesses and the capital they need and leverage networks like you in the process to be able to distribute to them. So we are exploring direct lending at the SBA on two fronts, both for the small dollar, $150,000 and under loan, which we know that has always been a challenge in the marketplace, and the SBA wants to be able to partner with lenders. Our expanded lender network, we've grown from over 1,000 lenders to now over 5,000 lenders, and be able to work with that expanded network to make sure that you can leverage the balance sheet of the federal government to deploy loans through our direct lending program into the community and make sure that all of our entrepreneurs can access capital with various products out there in the marketplace. We're also looking to deploy a direct-to-venture program that could really help our businesses, our growth businesses, with working capital, especially as we're trying to increase Made in USA and increase our supply chain resilience by reshoring so many of these critical industries. So there's lots of opportunity with the SBA's programs to be able to make an impact in the marketplace with capital products that will advance our small businesses. Both of those would leverage our existing portfolios of the 7A and the 504 language, so I think advance our entire portfolio in the process. And I'm excited that you'll be hearing a little bit later in depth from Therese Meers, who joined me recently as our Deputy Associate Administrator for the Office of Capital Access, and she'll be diving in a little bit more into some of the plans around the Build Back Better agenda, including Community Advantage, as well as going into our plans around micro-lending and prime grants, things that we're really committed to, because we know that they're critical components of making sure that we can help our underserved small businesses. And, I know that you are all on the front line, as I said before, but I think in this moment of crisis, this is a time where we can be innovative. We can leverage the strong attention that's on small businesses and really keep our innovation economy going in the process as well. So as we look to the bipartisan infrastructure deal and the Build Back Better reconciliation bill, we know that small businesses are top of mind. They're top of mind in the Biden-Harris administration, as is equity. And as you all know from working with me in California, that's where my commitment lies as well. And so know that the SBA wants to be a strong partner with you as you look to serve your underserved markets, your underbanked, your under-resourced communities, women, people of color, as well as rural, low-income, and veteran communities, to make sure that they are positioned for success and to take advantage of us as we rebuild the economy together. So thanks for having me today. I know that you're going to have great conversations, and I look forward to hearing your feedback once you hear more in detail as we move forward with these programs and design them together.
Wow, well, thank you so much, Administrator, for taking the time to join us today. So great to have you here with us. And obviously, thank you for all your efforts to bring the needs of the very small businesses front and center in the conversation for economic recovery. We really appreciate your time today.
You're welcome. Thank you. It's great to see you all.
Bye. And as the Administrator mentioned, we're going to have also now moving to our next presenter from the SBA's team. We're going to be joined from Therese Meers. Therese was recently appointed by President Biden's administration as Deputy Associate Administrator for the Office of Capital Access at the U.S. Small Business Administration. Therese's career in government focuses on the intersection of small business and the law with a specialty in federal contracting. She previously served as senior counsel for the Senate Small Business and Entrepreneurship Committee. During the COVID-19 pandemic, she facilitated $1 trillion to our nation's small businesses in forgivable loans, low-interest loans, grants, debt relief, and technical assistance. Before her work in government, Therese launched and sold Viking yogurt across the United States using SBA's tools. She was certified women-owned and Hispanic-owned business. So welcome, Therese, for joining us today. Take it away.
Thank you, Carolina, and thank you, Administrator Guzman, and all the Cameo staff who've worked so hard to pull together today's MicroLenders Forum. The opportunity to meet with you today at Cameo's 2021 MicroLenders Forum is both timely and necessary. It's been 19 months due to the COVID pandemic that we have been on pause to meet as a large group, and a virtual setting allows us all to connect from Washington, D.C. to California and focus on key work on small business rebuilding and recovery. It's amazing the technology that has been built by innovative companies during COVID to keep people connected. This morning, I was addressing small business contractors around the country on how to obtain capital using SBA's lending tools. And now I am honored to be here today surrounded by you, leaders in microfinance, microbusiness, and financial inclusion in the United States. The work you do is absolutely necessary to reach small businesses that aren't served by traditional lenders and SBA's programs. You, as mission-based lenders, are best situated to meet the capital needs of underserved businesses. You are key to helping entrepreneurs build family wealth and prosperity in their communities. You're reaching into communities and taking risk to stimulate jobs and growth. And you all have showed up and answered the call for the Paycheck Protection Program and Restaurant Revitalization Fund. And we can't thank you enough here at SBA. In 2021, MicroLenders approved over 500,000 loans totaling $8.5 billion. As Deputy Associate Administrator for the Office of Capital Access, I am making meeting SBA's partners and customers, all of you, central to my role to deliver excellent customer service by the agency. You heard from Administrator Guzman that top priorities for SBA is being customer-centric, technology-forward, and equitable, as she leads this agency into rebuilding and recovery. Just last week, the administrator announced a major milestone that in less than 2 months, 1 million borrowers applied for direct forgiveness for loans of $150,000 or less through SBA's PPP portal. The direct forgiveness portal has given the smallest businesses the ability to apply for PPP forgiveness quickly as we move forward to rebuilding and recovery. This portal highlights the agency's commitment to equity, meeting customers where they are, and improved technology and IT systems. We're all aligned, SBA and its partners, the Biden-Harris administration with Build Back Better, and the majority in Congress, both in the House and the Senate, in advancing access to capital to our nation's smallest of small businesses, businesses that have been too often overlooked. Congress has tasked you with an important mission. You fuel very small businesses, particularly low-income business owners and women, minority-owned, and veteran-owned businesses to obtain loans that enable them to create jobs. Capital is a lifeline for our nation's small businesses, and is the difference between success and failure for them. Sufficient capital and credit enable entrepreneurs to get their businesses off the ground, while technical skills help to keep the doors open. And Heidi, I didn't know if you could put up slide 1 on the screen.
We can make that happen.
Perfect.
Everybody might want to click and drag Teresa to the right so the slide goes big.
So this is a snapshot of the microloan program nationwide. In front of you is actually a data tool that we use internally here at SBA. It is an interactive tool, but what you see in front of you is a screenshot that I have taken of the microloan program data nationwide. Nationwide, we see an upward trend from 2017 to 2020 of the number of microloans, hitting 5.5 thousand in 2020. You can see the bar graph on the upper left-hand side. We do see a bit of a dip in the data, both in the number of microloans and the loan amount in 2021. And this is expected because you answered the call for both the Paycheck Protection Program and the Restaurant Revitalization Fund. And you can see this reflected in both the left-hand side graph and bar graph and the right-hand bar graph as well. Nationwide, the average microloan amount is over $14,500, with the average interest rate being over 7%. The majority of microloans went to existing businesses for working capital, with funds going mainly to full service restaurants, Those are restaurants where you sit and eat and then you pay afterwards, as well as beauty salons receiving a majority of the funds. You can see this reflected on the pie chart in the right-hand side with all the various colors, which breaks down industries by microloan amount received. And as I was digging through the data, there was an interesting data point I just wanted to share with you nationwide during the pandemic. Local trucking, including Amazon delivery, long-haul freight, and taxi services, are actually the number 1, 2, and 3 industries nationwide for Black microloan businesses. Between 2017 and the end of September 2021, these businesses made up 54% of Black businesses across America. Heidi, if we can put up slide 2, that would be great.
That's slide 2.
Perfect. In California, this is a snapshot of California. From 2017 to 2021, you have similar trends as the nationwide data, but some differences. The average microloan amount is over $23,000, with the average interest rate being just over 7.5%. The majority of microloans went to existing businesses for working capital. Microloans mainly went to both limited service and full service restaurants. And limited service restaurants being those where you pay first, get your food, and then you can sit down or take it with you. The data just continues to show that you are reaching into communities and taking the risk to stimulate jobs and growth. The portfolio for California only has had a 6.8% charge-off rate during this period of 2017 to the end of September 2021, which includes the pandemic months. It also shows that from the CARES Act, the Section 1112 debt relief payments granted by Congress helped micro businesses survive. With those payments, the current late payments in the portfolio to date is only 3.45% by number and 2.7% by dollar. I wanted to give you some updates as well on the microloan program. Beginning October 1st, the maximum amount of all outstanding loans to an intermediary under the microloan program is going to be reduced from 10 million to 7 million, with 7 million now being the new increase. And beginning October 1st, the maximum amount an intermediary may borrow per year is 3 million, with 750,000 being the maximum during the first year of participation in the program. Beginning October 1st, the maximum term of a new microloan is 7 years. And the waiver of the 25% matching funds requirement for technical assistance grants, and the requirement that not more than 50% of grant funds be used for assistance, and not more than 50% of grant funds be for third-party technical assistance, also ends on October 1st. So what does moving forward with rebuilding and recovery look like for SBA's lending programs? Front and center for us is continuing to fill the credit gap for underserved businesses with the new direct lending and direct debenture initiative. So if the budget reconciliation bill, the American Jobs Plan that is currently being worked on in Congress were to become law, the SBA Direct Lending Initiative would offer a direct loan product for the smallest borrowers, underwriting the product, making it available directly through the SBA, and partnering with mission-based capital lenders like all of you to deliver credit. Built off the existing 7A loan program, the direct lending program would offer single-digit interest rates and 7A terms for all small businesses on loans up to $150,000. And small government contractors and manufacturers would be able to access loans up to 1 million. The second program, the SBA Direct Debenture Initiative, built off the existing 504 loan program, would solve two problems stemming from gaps in traditional financing. First, traditional small business financing does not always align with the capital needs of project-based government contracting and manufacturing. Direct debentures would provide these businesses with the working capital they need to increase small business participation in the nation's supply chain. It would allow these businesses to participate in a historic investment in the nation's infrastructure. Second, equipment projects like renewable energy projects with long-term operating costs do not always have lender appetite and do not always have attractive terms for borrowers. Congress, by creating a new structure from the existing 504 program and legislation with a direct debenture program, would allow for SBA to help meet these needs for small businesses. We need you and your continued partnership to ensure that SBA reaches underserved borrowers. These programs would incorporate partnerships with you to leverage the government's balance sheet while earning fee income to finance borrowers in underserved communities and provide technical assistance that increases the likelihood that the borrower is successful and pays back the loan. SBA projects that the direct lending program could cost $4.4 billion over 10 years, and the direct debenture program to cost $2.7 billion over 10 years in order to offer competitive terms, build these mission-based capital partnerships, and reach underserved borrowers. I encourage all of you to review the bill text that was passed by the House Small Business Committee earlier in September and is posted on their committee website, so you can see the outline and the structure of these programs as envisioned by Congress. If this budget reconciliation bill were to become law, SBA's Community Advantage program will be granted full program authority within SBA's flagship 7A program. The pilot program would have stability and certainty for existing lenders and attract new lenders focused on underserved markets. The Office of Emerging Markets would be established in SBA's Office of Capital Access to focus on business development of businesses in underserved emerging markets. The office would create and recommend policies for the microloan program and SBA's other access to capital programs for small businesses in emerging markets. The office would work to establish partnerships and to improve the success of these small businesses, and would review the effectiveness and the impact of the microloan program and SBA's other loan programs for small businesses in emerging markets. There's always the possibility too that the American Jobs Plan does not become law, and so we're continuing to look and see what happens. But if it were not to become law, we're still working forward towards getting capital to underserved businesses, doing a deep review of our regulations and our standard operating procedures, and to continue to work internally towards these initiatives. And I'd love to know if there are any audience questions, if we have time, maybe for one or two, or if anything I can't answer at this time, I'm happy to take back to SBA's Office of Capital Access for me to look into and further research. I also want to know that I'm accessible by email, and I can be reached at Therese.Meers@sba.gov. That's my first name dot last name @sba.gov. And thank you so much for this opportunity to speak to all of you.
Thank you so much, Deputy Administrator Meers. Heidi did include it also her email in the chat. If any of the audience would like to ask any questions regarding the all the information we just heard, very important and affects a lot of you, please do email the deputy administrator or Heidi, so we and CC, make sure CCS so we can share the answers with the network. But we really appreciate your time sharing all this information with us. So we are getting so much information today, and it's so great to hear how important it is for all of you to be on the lookout. I think we've learned that in the past, it's 19 months now of this, of how we need to keep updating ourselves with the amount of new initiatives and new programs that are coming up. We are going to continue with our speakers at the national level now. I'd like to welcome our next speaker, Ibrahim. She serves as a policy advisor, National Economic Council at the White House. Previously, she was the economic policy advisor for Congresswoman Ayanna Pressley and focused on banking, tech, and civil liberties issues. As the Congresswoman's liaison to the House Financial Services Committee, Aya played a critical role in efforts to reform the credit reporting system, expand the social safety net, and advocate for greater equity in federal programming and responses. So thank you, Aya, and I'll take it away.
I just want to start by thanking everyone for making the time to be here in virtual community, and want to say that I'm so honored to be here to share just some of what we've been working on to address issues of financial equity and access, which I know you all think about and work on every single day. In many ways, this pandemic has both exposed and further exacerbated inequities that predate the public health and economic crises, inequities that presented their own set of challenges as we work to provide relief to workers, families, and businesses in need. I know that you all have been invaluable partners on the latter, working diligently to support efforts to reach quote unquote hard to reach communities. While it is often an apt term, it's one that I personally, frankly, struggle with because, hard to reach does not mean impossible to reach. And it certainly does not mean that we should not try to reach these communities.
With a million businesses, I think you reach a goal of 1 million businesses.
Okay, perfect. Others have already highlighted that, thanks to the new streamlined process that SBA launched, and we anticipate that we'll reach another 2 million small businesses. But the thing that I'll just note here is that, this new streamlined process takes borrowers on average 6 minutes or less to complete, and 2/3 of borrowers are completing the form on their phones, which again just demonstrates the success of simply meeting people where they are. And then a final notable figure comes from our focus on community lending. We through changes and very intentional focus, were able to double the amount of loans in 2021 that were distributed through community financial institutions, like many of those on this call, versus the previous year's allocation. So this year we distributed $34 billion through community financial institutions versus just $17 billion in 2020. So that's twice as much money coming out of a much smaller pot. Which again is only made possible through partnerships with organizations like those here today. And in this continued spirit of reaching people where they are, the American Rescue Plan included $100 million in funding for the Community Navigator program, which aims to use trusted voices in community to reach underserved businesses and business owners. So in other words, it's a community-based solution to the ubiquitous quote unquote last mile problem that will ensure that people can access relief programs available to them. And then finally, just looking forward to Build Back Better, you recognize that underrepresented communities have been particularly hard hit by the pandemic, that too many were left behind in the initial rush to get economic relief out the door. Cdfis and other mission-based lenders, like those on this call, stepped up to increase lending to underrepresented businesses when they needed it most. the Community Advantage program has been a valuable tool for lenders, and it's clear that this program has matured into one that deserves long-term stability and investment. We need to continue empowering mission-based lenders to fill the gaps left behind by more traditional financing sources, which, is also why Build Back Better also includes a plan to create a direct loan program for loans of $150,000 or less, which will be another opportunity to partner with community and mission-based lenders. The NEC and this administration more broadly are deeply committed to figuring out how we can make financial services more equitable and accessible. And everyone on this call plays an important role in helping making that a reality. I am part of our team focused on household finance and consumer protection issues, looking to address inequities that predate the pandemic and explore where technology can help make the system more equitable and where it can potentially hurt that goal, which is an area I know that you all are thinking about as well. So in some ways we share a portfolio. So in thinking about that, how are we ensuring that, again, we are offering products that meet people where they are, that the products meet the scale of need, whatever that scale is, and that smaller doesn't mean less in terms of the quality of financing or support. Micro businesses are a critical part of our economy and of our recovery. And the support that you all have offered and the partnership that you've offered to help deliver the relief that we have set aside and provided for these businesses has been, again, just invaluable. But looking forward, how can we be creative about not just, the delivery of benefits, but access to financing that reflects the kind of need, whatever it might be, that products that people can understand, that support their goal of economic and financial empowerment, alternatives that are safe, and looking ahead, I know that you all will continue to be very critical partners in that work, and as we are ramping up our own consumer protection and household finance work and focus, looking to you all to share your insights based on your experiences and engagement with these communities that we're really trying to center in this recovery. I apologize for the technical difficulties again, and thank you all for your patience. And hopefully this is the first of many conversations. Heidi has my contact information. I am but one in a team of people committed to this work. And I know that I have many colleagues with even deeper expertise on a lot of the issues that you all have focused on. So happy to make those connections as well. And again, just thank you all for extending the invitation. Honored to be here and to hear from you all.
I just want to thank you, and I'm excited to have further conversations with you because we talk a lot about the small business owner as a consumer when it comes to financial products. So hopefully we can continue that conversation at another time.
Absolutely. Thank you.
Great.
Thank you so much. Definitely, we all can relate with the technology difficulties, so don't worry about that. We are so glad we were able to hear from you, and as Heidi mentioned, definitely talking about how consumer loans affect also small businesses is important for us, but it also kind of brings up the idea of how creativity has been one of those skills that the ecosystem and the Cdfis have been really honing in during this past couple of years almost, but definitely just really looking how we can better support these communities. So we look forward to continue that conversation, and thank you so much for joining us today. We are now moving a little bit to the state small business policy. So we are kind of changing we're shifting from the national level to the state level, and I'm thrilled to introduce you to our next speaker. For those of you in California, Scott needs no introduction, but we have a wider audience today. So Scott was appointed by Governor Newsom in 2020 to lead the California Infrastructure and Economic Development Bank, IBank. Before that, the longtime Northern California resident was a partner and head of investments for the Omidyar network, where he also led the firm's activities to provide energy to off-grid communities around the world. Wu was a member of the founding team of Upstart.com and co-founded several venture capital and investment firms that together manage billions of capital. Scott has spent a lifetime of uniting his strong finance and innovation skills with a passion for global philanthropic endeavors. He served as a White House Presidential Innovation Fellow and Senior Advisor to the Innovation Funds of USAID. Scott Wu is the Director and former Chair of the U.S. Committee of Refugees and Immigrants, Director of Callisto Sexual Assault Reporting Platform, and former President of Aim High Summer School Network. He worked in Tanzania on development projects and in Bangkok to help combat child prostitution and co-founded a middle school for the underprivileged. It's such a pleasure to have you today, Scott. Take it away.
Carolina, thank you so much for that kind introduction. And I'm just thrilled to be here today with some of my colleagues and former colleagues like Administrator Guzman. I remember vividly last year at the height of the pandemic, Isabella and I probably spoke almost on a nightly basis, trying to come up with solutions to address the small business crisis that was underway. And she was a tremendous help for our launching the several programs that we were able to launch last year, and is a continuing inspiration for what we're doing today. So with that, I also want to thank our great partners at Cameo for including us today, and for many of our lending partners that I see on this call. This is just such an incredibly dedicated community pursuing a critical mission that we're seeking to support. So for many of you and your clients, last year was just a period of hanging on for survival. And we really hope that this year is about recovery and rebuilding. And we want to provide the assistance wherever we can. And so I'm just going to start with a few short words and leave some time for questions, leave lots of time for questions for you to pose to me about what we're up to, what we're prioritizing, how we're trying to seek to support you in your critical work. So for the first slide, the next slide is just a very quick recap for those on the phone that are not familiar with IBank. Our mission is to promote jobs, a strong economy, and to improve the quality of life for all Californians. To this date, we've issued about $43 billion of bonds and direct loans. We've also housed the state's Small Business Finance Center, and that has provided over $3 billion of small business loan guarantees to date. Last year, we launched our climate fund and several new initiatives for small businesses, which I'll speak to in a minute. And then actually another important point is throughout the heart of the economic crisis last year, we were able to fortunately maintain our AAA credit rating. On the next slide, I'll talk about our Small Business Finance Center. And so last fiscal year 21, we were able to complete more than 2,000 small business, micro business, and disaster relief loan guarantees, supporting more than $240 million of loans and helping to create or retain nearly 18,000 jobs. We also recently completed our first 4 climate tech financings, and we plan this coming year to take that program statewide from its current pilot base in the Bay Area. When the pandemic took off, really started taking off last March, we immediately launched our COVID microloan initiative on April 2nd of last year. That was targeted towards the underserved and those that had little access to federal relief funds. To date, 87% of those that received those COVID microloan guarantees have gone to women or to minority-owned businesses or those located in low and moderate income tracts. Those loans average $44,000, So less than 10% of our typical loan guarantees, and those businesses average just under 5 employees. The next slide is the other program we launched later last year, when it became clear that the Cdfi community last summer and fall was in desperate need of capital. We provided the anchor investment to help launch the California Rebuilding Fund. It was launched and active starting November 20th of last year. And we did this via a very broad public-private partnership that we were very proud to help bring together. And Isabella Guzman was very critical in helping us bring together those parties, as well as the California Recovery Committee in the governor's office. We hope for this to be not a temporary solution, but for this to really constitute permanent infrastructure to the Cdfi ecosystem. And that will continue supporting the most underserved small businesses across the state. To date, it's provided about 700 loans for nearly $50 million by a dozen participating CDFIs. 81% of those loans are either in a low to moderate income tract community or are to businesses owned by a female or BIPOC business owner. And so it has done a good job of reaching the target audience. We designed this entity to provide access to liquidity and for risk mitigation for the CDFI community. And so for businesses, we wanted a simplified customer experience, a transparent and affordable product. I believe that it's done a good job achieving that. And now that the state's COVID grant relief programs and the federal relief grant programs are winding down, this will be a very important tool for the underserved small business community for years to come. The next slide is what we're currently working on, which is the state's Small Business Credit Initiative, SSBCI, that was passed in the American Rescue Plan back in the fall. Just yesterday, a notice was published by US Treasury to give us a little bit of guidance in advance of their delayed detail guidance that we're still expecting. But essentially, in April of this year, California was provided an initial allocation of $895 million for small business program support. And that $895 million comes from the first $6.2 billion tranche of the $10 billion SSBCI program. So IBank and the State Treasurer's Office will share this $895 million to recapitalize our 3 existing programs that we have: the Loan Guarantee Program, the Capital Access Program, and the Collateral Support Program. We're still awaiting allocations and awards of the next $3 billion. There will be upcoming $1.5 billion component dedicated to socially and economically disadvantaged individual businesses, and if a following $1 billion available for the programs that are targeting that SETI market, socially and economically disadvantaged individual market. The programs that target that the best will be eligible for the second billion. So there's $2.5 billion for SETI, and then there's another $500 million available for technical assistance programs that is yet to be awarded. On the next slide, we'll talk about what we're currently working on and the prospects for those. And so, as I mentioned, we already run 3 of the 5 existing allowable programs under SSBCI that we constituted following the SSBCI 1.0 back in 2010. And so there are 2 programs that the state of California did not take part in last time: loan participation and a state venture capital program. We are very much currently pulling together a proposal for a prospective venture capital program, and we're contemplating some ideas and notions about a loan participation program, which may also come to fruition. But in essence, the deadlines were clarified yesterday in the notice. December 11th remains the statutory deadline to get a proposal into the US Treasury. We plan to work together with our Treasurer's Office and along with IBank to put a proposal in by December 11th. And then that initial application needs to be fully complete by February 11th with a completed application. And then subsequent to that, on March 31st of next year, the technical assistance program applications are due. And so we can go to the next slide. Essentially, that's all I had to share, but I know you might have a lot of questions, so I want to leave time for that. But essentially, the small business community is a key priority of ours, especially the underserved and the disadvantaged small business communities. And so after last year of hanging on for survival, we really look forward to working together with all of you to build a better future. And we couldn't possibly do it without you, all of your institutions on this phone call, and your essential work in the most difficult communities that you're able to reach alongside of us, and with whatever funds and programming support that we can provide for you. And so we'll keep doing that. We're continuing to receive input. We hold stakeholder calls on a periodic basis to get as much information as input from you as possible. And I want to take this occasion to give you another opportunity to ask questions or provide input to IBank and the state to help us fashion the right programs that would be assistance to you. So with that, thank you very much.
Thank you so much, Scott. We have somebody raising his hand. So Jay Diallo, if you could unmute yourself and ask your question.
Yes, good morning, Scott. Thank you so much for your service, and thank you so much for coming and giving a presentation. I have a question regarding the IBank process into how do we get us. So let me just introduce myself really quickly, sorry. My name is Jay Jallo with the First Community Capital. I am the founder and CEO of a small Cdfi. We just become a certified Cdfi less than a year. So I know we have a long ways to go, but how do we become an IBank? I know we new, so I'm not, I know we have a long ways to go, so I just need to know the process.
Yeah, so you can come on our website and they'll have information, contact information. You can send an email to us. You can reach out directly to us by phone call, but our information is available for you to reach our Small Business Finance Center manager. I think she may be on this call today, Megan Hodap, and she will help guide you through the process for Cdfi to become participating a partner in some of our programs.
Okay, thank you.
Thank you. Griselda?
Good afternoon, everyone. My name is Griselda Martinez, and I have a question for you, Scott. It sounds like the numbers you're highlighting represent a great success in reaching those communities that are quote unquote hard to reach. What would be your advice in being successful in doing that and engaging institutions that can support those goals?
So I wouldn't necessarily describe it as a great success yet. I think it's a great start. And so the numbers are still quite modest. The percentages are favorable for what we had hoped to reach, but we'd like to see a lot more activity. And as you all know, this is the hardest community to reach, right? They're distrustful, they're not aware of what's available, and you really need feet on the ground to be in those communities to reach this type of target population. We at IBank don't have that, but we partner with our financial development corporations, with Cdfis and other lenders throughout the state. And we want to help, activate your client base. And so that's how we expect to reach them via our partnerships with you.
Scott, and on that note, a follow-up, what would be your advice in engaging community organizations to entice partnerships and reach common goals?
Yeah, I mean, I think part of it is the mission and the mandate of the various institutions on this phone call today, right? And so to find this community, to have this type of organization that brings so many of these players together is critical. And then beyond that, they need resources, right? You need capital, you need to have technical assistance availability, you need to have funding capital as well as operating capital. We're trying to work along that spectrum, and we at IBank have tools to help share the risk that you're taking on by approaching these communities. And so I think it's a full suite of a toolbox. There's no single bullet that says, okay, if we did this, we would have lots of activity in this target market. It's, you need everything, and it's just so hard. And so wherever we see a gap, and that's why we always look for your input, because when we notice a new gap, we try to find some solution that can help address that gap. And there's always going to be gaps, right? This whole market is defined by critical gaps, and that's why they're so poorly served in the first place.
Thank you. We have another question, Jason.
Hello. Hi. So, sorry for if this is an ignorant question, but and this might not be, maybe for Scott, but maybe anyone else. But what is the relationship between Cdfis and SBA? So I understand that the Cdfis are, from the U.S. Treasury. The SBA loan guarantees, like the 7A 504, are obviously the purview of SBA. But there are a lot of nomenclature that are sort of mixed. They sound similar, like CDC, Community Development Corporation, versus Community Development Financial Institutions, CDFIs. I've also heard that it might not be a good idea to mix the two, because you might end up having two bosses, which would be not a good thing. So what are your thoughts on sort of like the micro lenders, which are CDFIs, doing SBA guaranteed loans? Is that
so? I could certainly give you my answer, but we have the experts on the line, so I'm going to defer to Carolina and others on this phone to give a more specific and probably accurate answer.
okay?
And sorry, and I was gonna say definitely there is definitely certifications that our lenders are looking for. The Cdfi certification comes through the U.S. Treasury. I'm sorry, but several of our Cdfis are also lenders with SBA, so they can actually kind of get certified to provide some of the products that SBA offers. That's that relationship. And a third component, which is why probably we're talking different items here, is the IBank also certifies some of the lenders to provide the state loan guarantee program. So it is basically this kind of certifications is mostly to allow them to provide and to offer some of the programs that our communities might benefit better from. But definitely the Cdfi certification with the US Treasury is the one that more generally accepted for bank funding or even for Cdfi fund funding as well.
Thank you.
Scott, you have mentioned also a lot about some of the stakeholder calls that you've kind of hosted to really get feedback from the lenders. So if somebody in the audience hasn't been able to be on one of those calls, how they could join in, or could you share that information through, I mean, obviously when we hear we could share it through Cameo, but how can they get into your database?
Sure. Please either send me a note or send it to our the address on our website, and we'll be sure to include you in our upcoming calls. The calls began to wane in the recent months as we had no news to share because we were all awaiting U.S. Treasury guidelines, and we're still somewhat in that holding pattern right now. But the early calls are really to help us identify what are the key gaps, what are the programs that people are looking for and looking to that maybe aren't provided in California. And so from that, we're working towards, we decide to significantly recapitalize our existing 3 programs, which seem to be doing a good job reaching the intended markets. And then with this new SETI a proposed allocation that will soon to be awarded from US Treasury, we decided that launching a state venture capital program may be a good solution to use some of that SETI money, not for general high-tech Silicon Valley venture capital, but for venture capital to those that never have access to venture capital, to those that are the most underrepresented fund managers, the most underrepresented and underserved geographies and entrepreneurs. And so that's what we're doing research on right now to see if that's the type of program we might be able to stand up. And we're also currently contemplating other ways to provide capital to the Cdfi community as well.
So can we share the information about those meetings with the network?
Oh yeah, please do.
Everybody would be.
I actually, whenever we have a meeting, we want to let you know so you can let your members know, because we want as many of them as possible included.
Okay, that's great. So we'll be in the lookout for that. Thank you so much for opening those spaces for feedback. It's definitely great to have that direct communication as you're putting these programs together.
And thanks so much again for including IBank in your conversations and being the conduit to your community.
Yeah, absolutely. If anybody has, I know a lot of people has a lot of questions about the SSVCI. We, we will be able to probably channel those questions in. Anybody would like to send them through Heidi, we can put them together and send them your way. Sure. So we can share with the network. It was great that they were out yesterday, but it was not enough time to get a lot more knowledge about it. So definitely interesting about those questions moving forward.
I mean, it looks like from yesterday's notice, there will be a little bit more latitude and flexibility beyond the December 11th date to continue to amend and come up with solutions. And so we will be in a position to put our proposal in by December 11th, and we'll still have a little bit of time subsequently to fine tune the program plans that we want to pursue.
Perfect. Well, thank you so much for joining us today, Scott. And just following up on what he was mentioning, Scott mentioned the California Rebuilding Fund, and that is one of the positive outcomes that we've seen through all this pandemic, how all of several mission-based lenders and CDFIs have really come together to start putting together new initiatives that could leverage public and private funding and really focusing reaching out those communities. So we are really excited to be able to support that initiative. We are obviously grateful for IBank's support. And I just also wanted to reiterate to the audience that there are several initiatives right now that are bringing CDFIs together. And it is really important, as we know in the past few months, CDFIs had struggled with liquidity. CDFIs were really trying to keep up with all the new programs that were opening up and that they could really use to help the underserved communities. So I wanted also to kind of mention before we go to a brief break, the California Coalition for Community Investment, which is CCCI, and that is a new coalition that started in California almost 2 years ago, I would say, and it not only includes the small business CDFIs, but it also includes housing CDFIs, commercial CDFIs, and everybody coming together to really advocate and find more funding for the industry as a whole. So I think it's the first time that all the CDFIs are coming together, and it'll be great. If you want more information, we will love to send obviously the link for you to do that. But I wanted really to share the fact that we are in a very special moment. I said it in my remarks earlier, we're no longer best kept secret, but we are also really leveraging each other's strengths and really connecting among ourselves to bring the capital and the resources that the very small businesses in underserved communities need. So this is a great opportunity for us to connect with our state officials to learn more about federal initiatives and continue working and growing the programs that you all have in your CDFIs. So with that, I'd like to turn it over to Heidi for a little bit break. I know we've had a lot of great information, and we might get a little stressed here in the video. So Heidi.
I'm going to get out of my chair, and if you want to as well, we do this kind of often. I'm going to stand up, so I'll just move my camera a little bit. I'm going to stand up, stretch my legs, put my arms up in the air, and you guys should do the same. If you don't want to do it, shut off your video, stretch to the left, stretch to the right, take your left arm and stretch to the right. It just feels good to move. Maybe a little twist to the left. keeping your center and just twisting your upper torso, twist to the right. Just feels good to get your body moving again. I know we've been sitting. We did have a break planned. We had a little bit of a buffer, but we're running just only 10 minutes behind. So we thank all our speakers and all of our guests and you all for your flexibility. With that, I will hand it back to, I think it's you, Carolina.
Great. So it definitely helped standing up and kind of stretching a little bit. And now I would like to, first, before we move to the next speaker, I'd like to take some time to recognize Cameo's team. As you know, Cameo has been busy in the past few months, and last year really proved the need of some of our value of Cameo's network, right? And we couldn't do it on our own, so we've actually grown quite a bit. And I wanted to make sure everybody was aware of who is part of our team, and also had an opportunity to see Cameo's team's faces, even though we haven't been able to meet in person. So if our all Cameo staff could maybe raise their hands so you can come up to the start of that would be great. We do have Heidi, who you've heard, and she's been in several of the meetings that we've hosted over the past year as our VP of Engagement and External Affairs. We also have Emily Gassner as our VP of Strategic Initiatives.
Hi.
And Cdfi Incubator Director. And we have Lisa Rivera as our Outreach Manager, and Rocio Connolly helping us at the operations and Cameo. We do have also a new person for finance and operations manager who wasn't able to join us today, but it's good for all of you to connect with Joan Johnson. We are really happy, and well, you can definitely see us in the gallery when you can see us with our background, so you know who we are. But thank you everybody in Cameo's team for all the effort to put all this. So we are a small but mighty group that are really putting all the efforts to bring you all this valuable information, and we are always listening to your needs and what we can do better. So thank you again, and with that, we're gonna be moving a little bit more towards what Cameo has been up to. But first, we would like to welcome to the stage Megan Teare. As we said at the beginning, we're really happy to have Wells Fargo sponsoring this event, but they've also been supporting Cameo for many years, and they've been really supporting a lot of the capacity building programs that we've put together and are able to provide to our membership. So we're really happy to be able to have Megan with us today. Megan has been working in the community development field for 25 years. She's currently a managing director with the Wells Fargo Community Lending and Investment Group, where she manages the program that provides enterprise-level capital to community development financial institutions and nonprofit housing developers. Megan also serves as a board member of NeighborWorks Capital Corporation. Before joining Wells Fargo, she served as Senior Loan Officer at the Macaulay Institute and as a consultant to nonprofit housing developers. So thank you so much for joining us, Megan, and please take it away.
Thank you so much, Carolina, and good morning or afternoon, everyone. As Carolina said, my name is Megan Teare, and I'm with Wells Fargo's Community Lending and Investment Group. And my colleagues and I are thrilled that Wells Fargo is this year's forum sponsor. It's really wonderful to be with you all here today. I see a lot of familiar faces, and I'm happy to meet new people as well. I want to first start off by thanking Carolina and her great team, who we just met at Cameo, for putting the forum together. I also want to acknowledge and thank each of you for being such a consistent resource for entrepreneurs who've gone through so much in this pandemic, keeping their doors open to serve their communities and put food on their own tables. Right now, more than ever, Wells Fargo sees the importance of continuing to build the capacity of CDFIs. In my world, we've directed our debt resources, so our lending capital, towards several state-level COVID small business recovery funds, including the California Rebuilding Fund, which we were just hearing about. And my foundation colleagues have offered their support through a tremendous grant resource program called the Open for Business Fund. Those of you who aren't familiar with it, this is a roughly $420 million small business recovery effort, which was created by donating all of our gross PPP processing fees from our PPP lending in 2020. We're taking $250 million of that and making grants to scores of CDFIs across the country. Already, just so far, the program is helping about 22,000 minority-owned small businesses keep an estimated 66,000 jobs nationwide, and we'll continue to announce new grants throughout 2021 and into 2022. More locally, we are thrilled to support Cameo's Cdfi Incubator, which you'll hear more about shortly. The only one in the country set up to expand staff knowledge and best practices, use online tools more efficiently, and scale impactful micro-lending volume, reaching more low and moderate income small businesses and entrepreneurs of color. So to talk more about the Cdfi Incubator and share the new brand, I'm going to turn it back to Carolina and to Emily, but just wanted to thank you all again so much for joining the forum today. Thanks again to Cameo for putting it on, and enjoy the rest of the afternoon. Thanks, Carolina and Emily.
Thank you so much, Megan. I'll just, without any further ado, I'll just turn it over to you, Emily.
Okay, sounds great. All right. Well, thank you so much, Megan, Teare. You've been such a wonderful resource for CDFIs and advocate, and Wells Fargo has been a great source of funding for many, many years for CDFIs. So I would like to now share my screen with you and tell you a little bit about Cameo's Cdfi Incubator. So hopefully everyone can see the presentation. Let me know if you're not able to. I'm the director of Cameo's Cdfi Incubator, and bringing 20 years of microlending experience as a practitioner to this incubator. So what is the Cdfi Incubator that Cameo has? I wanted to just start off with that question. And it really is a robust suite of not only services, but resources for the early stage microlenders who are getting started, learning how to make loans, and trying to incorporate best practices. So we provide training, consulting, lending capital, grants, technology, connections in a very holistic way to be able to serve these new CDFIs. The goal is really to, as an incubator, is to accelerate and scale impact, both with microlending to entrepreneurs of color, as well as to get more loans to low-income entrepreneurs. And a question that we get quite a bit is this actually new for Cameo? And in fact, it's not. Our branding is new that you're seeing throughout our presentations and such today, but really our programming started back in 2018. And what we're doing is continually expanding our offerings here in California, as well as beyond California. So now I'm going to show you a little bit more of our branding and walk you through a few details on the programs. So our first one that I'd like to share related to some of the program we have as part of the incubator is our Cdfi Essentials program, which is a year-long facilitated program where we typically have 8 to 12 organizations participate, and we have a monthly topic on CDFI lending and guest speakers who are industry experts joining us. And it's a real peer learning and a kind of long-term program that we have. Also, our MicroLending Essentials is a 5-day long underwriting training that sells out each time. It's so popular, and we get a lot of interest from around the country for this because it's a one-of-a-kind training that is not offered elsewhere. And so we have our next one is coming up at the end of October, and I believe we have just one spot left, but we're planning the next one for January. So you can let me know and we can get you on the wait list for the next time if any of you or your staff need that kind of professional development. Our impact fund is essentially our loan to lenders program, by which we lend out money to newer CDFIs that might not be ready for investment from bank CRA dollars or from the CDFI fund quite yet, but we provide some of that seed funding to be able to lend out in the community and build that track record. So far, we've lent out $600,000 through that fund to 4 different CDFIs. And a new offering, our loan loss reserve grant program, we're offering because we know how hard it is for newer CDFIs to be able to have the equity on their balance sheet to be able to mitigate some of the risk of the lending. So we're looking to provide loan loss reserve grants, and we've provided our first 5 recently and looking to grow that. And then continuing to move to the right on this wheel is we're developing new programs around how to navigate every aspect of the CDFI fund, from applying for certification, applying for TIFA awards, renewal applications annually, and reporting, and how to be able to do all of that. We also have been over the last couple years aggregating our CDFIs on different lending platforms to help them to have online lending technology to scale and be more efficient in their lending. And then today, we're all benefiting from the MicroLenders Forum, our annual convening on best practices, topics, and trends related to CDFIs. And then finally, our consulting services, our one-on-one services to CDFIs and their staff around topics they would like to learn more about, whether it's the state guarantee program, new technologies and CRMs, the SBA microloan program, and how to obtain the state lender's license, for example. So those are just a few of the programs. And then just briefly, some of the outcomes we were pleased about last year. We worked with 12 CDFIs, training 75 staff, and we were able to get $275,000 out to 2 CDFIs that they were able to deploy in their communities. And we had 5 CDFIs on lending programs that we were aggregating. And also we saw a significant increase in loan units of 219% of participants, as well as 198% increase in the dollar volume. So we're really pleased about those outcomes. And looking to the future, in my new role as the Incubator Director, we're really looking to expand the programs. And so part of what I'm doing is I'm doing a lot of listening and conversations with CDFIs, both the new ones, of what they need and what would be most helpful, as well as existing CDFIs that, as they have staff turnover, really need professional development opportunities for their staff. So through kind of the end of this year, which is over the next 3 months or so, we will have incubated 20 CDFIs. We're looking to increase our lending by at least 30%, but I'm assuming it's going to be a lot higher given last year's track record. Training over 100 staff, getting close to $500,000 to 3 CDFIs, and holding 12 trainings and 20 convenings on best practices, and then having our CDFIs, 6 of them on the lending platforms, which involves a lot of kind of technical assistance on implementation and operationalizing those platforms. What I'm super excited about is just the opportunities to develop new partnerships. We hear time and time again that CDFIs need not only just the lending capital, but they need operational dollars and they need grants for loan loss reserve. So looking to partner to build that out further. And you might not know this, but Cameo is on its own pathway to becoming a CDFI as an intermediary. So that means we'll be applying for our own certification right alongside our CDFI cohort members in the incubator, and really looking to ways to create new curriculum based on the needs of our cohort members. going forward. And part of our strategy for next year and future years and our strategic planning is really around bringing more robust data outcomes and impact valuation to the incubator itself. And given the demand that we're seeing from outside of California is really bringing our work to a more national audience. So we have some really exciting things in store in the future. So on that, we don't have time for me to take questions right now, but I encourage you to both reach out to me by email and we can connect, set up time to meet, as well as at the end of the forum today, when we have time in breakout rooms for networking, I'll have my own breakout room. So please join me in that breakout room and we can chat more there. So thank you so much. I'll stop sharing. And let's see, from there, we're going to be moving into the next section of our forum with a presentation, and then I'm going to lead some small groups discussion. So please stick with us for the remainder of the forum. And with that, I would like to introduce our next speaker. I'm sorry, was somebody saying something there? Our next speaker, Rocio Sanchez-Moyano, who is the senior researcher at the Federal Reserve Bank of San Francisco. I'm really excited for what kind of information she'll be sharing with us today. She joined the Federal Reserve Bank of San Francisco last year as a senior researcher in community development, and her areas of expertise include housing, and asset building, with a special interest in racial equity and the experiences of Hispanic and immigrant households. At the SF Fed, her focus is on emerging trends in community development and finance and financial inclusion, including the role of fintech in low-income communities. So with that, I will hand it over to Rocio.
Great, thanks. I'm going to start my screen share here. Okay, hopefully everyone can see that. Thanks for having me. Thanks for sticking around to the last speaker presentation. Today I'm going to be talking about the Small Business Credit Survey and the results from the 2020 edition. Before I start, I just need to say that all views today are my own and not necessarily those of the Federal Reserve Bank of San Francisco or the Federal Reserve System. Oh, sorry, figuring out how to click forward while zooming. Here we go. So as I said, this is the results from the 2020 survey. They were collected from firms, small businesses last year in September and October. The results I'm presenting today are just on employer firms. There's a different report available online, and I'll have some links in some later slides to cover non-employer firms. When we're looking at the employer firms in California, we had 354 responses, and nationwide we had almost 10,000 responses. I should note that the 2021 edition of our survey is live. There's a link here, and I have a slide later in the presentation that you can share with small business owners. More data is always better, as we can do more types of aggregation and breakouts of different types of businesses. So I encourage you to share that all in your networks. So I was asked today to talk a little bit about California firms, and then also to talk about firms owned by people of color. Unfortunately, the data is such that I can't look at firms owned by people of color in California. So I'm having to split this in half and do California firms first, and then I'll do some national data on firms owned by people of color. So this slide has a lot. I promise it's the only one that has this many charts at once, but just a quick overview of what the profile of California firms looks like. You can see that California small businesses tend to either be quite new, so 5 years or younger, or they are on that other end of the spectrum and have been established for a long time, 21 years of age. The most common annual revenue is $100,000 to $1 million. But these firms tend to be quite small. 1 to 4 employees is what is the majority of small businesses in California. 33% of firms are owned by people of color, and 21% of these businesses are women owned. Perhaps unsurprisingly, given pandemic conditions last year, the majority of California small businesses were reporting that they were in poor or fair financial condition. So really seeing a lot of hardship through the pandemic. Only 4% of businesses were in excellent condition. And when they looked at their employee counts over these last 12 months, the majority of firms in California had to decrease their number of employees. And when they were looking forward, maybe a little bit more optimistic, less people were predicting decreases, but the largest group was predicting no employment change. So, stable at best, not something where they were seeing a lot of expansion over the next 12 months. We asked these firms about where they use financial services, and here firms can report multiple selection options, so anywhere that they have any sort of financial relationship. But you can see that predominantly businesses are using large banks. It's almost 2/3 of small employers in California, and it really dwarfs these other categories. The runner-up is small banks at 30%. You can see CDFIs are seem to be more significant in California than potentially in the US overall, but not a huge share of the financial service relationships. We asked firms what sorts of challenges they'd experienced in the last 12 months. And I will say that this question is available on this survey and previous iterations of it. So it's not a COVID specific question. I'll get a little bit later in the presentation into COVID specific questions. But of course, their answers are going to be reflective of the experiences they're having under COVID. You can see that 2/3 of firms are struggling to pay operating expenses, and nearly half struggled in paying rent or in making payments on other types of debt. And so then we ask those firms that are struggling, what sorts of actions are you taking to resolve these financial challenges? And nearly 2/3 of owners are saying that they're using personal funds to deal with the financial challenges in their small business. 62% had to cut staff or cut hours or downsize in some other way. And more than half of firms took out debt last year. And that debt is distinct from any pandemic relief related debt programs. So now pivoting a little bit to the COVID specific part of the survey, and we asked, how has the COVID-19 pandemic impacted your business? More than half of firms reduced operations, nearly half were able to maintain operations, but then had some modifications, and a full 30% of firms had to close for some period last year. Among those that are modifying operations, we asked to report the different reasons for this. And the number one issue for firms in California were the government mandates affecting their businesses, although it was followed closely with changes in demand for their products or their services. And again, in California, we have more than half of firms that are adapting to the health and safety guidelines. Among firms who expected the sales revenue to decline as a result of COVID-19, you can see here that they're really expecting really sharp revenue declines. 38% of firms are expecting revenue declines of at least 50%. And another 28% said that they were expecting revenue declines of 26 to 50%. Now I'm going to turn a little bit to the emergency assistance programs. And so here firms were able to report on what types of programs they applied to. You can see that PPP is the predominant program used last year in California at 83% of all the firms, but more than half at 58% also took out an EIDL loan. You can see that only 9% of small businesses in California reported not using any type of emergency system. Interestingly here, California seems to have a lot of participation in grants from nonprofits or foundations, and all of this was taking place before the California Rebuilding Fund or the California grant programs launched. So of course, that's not in this data, but certainly if we were to ask this question again, we would see that popping up in California. Now, it's also interesting to think about why certain firms didn't apply to PPP, right? So 83% did, but that tells us 17% didn't use the program. And the biggest concern among firms that didn't apply was that they wouldn't qualify for the loan, or that they were worried they wouldn't qualify for forgiveness of the loan. But we can see that a decent chunk of firms also reported being confused by the program or not being able to find a lender for the program. These both are more prevalent than firms that just said, look, I don't need PPP money. Turning a little bit narrower into the PPP program itself, when we look at firms that received funding, while the majority of firms did receive all of the funding that they requested, it's quite a bit lower in California than in the rest of the country, and only 64% received all of the funding that they had requested through PPP. When we looked at where firms apply to PPP, again, large banks are the most common lender, but you can see that the gap in activity is much smaller than when we looked at that generalized, where do you use financial services slide. So 47% of PPP folks applied through a large bank, but you can see a lot of activity happening with small banks and online lenders. Interestingly, in California, there was a lot of activity from online lenders. I saw this in earlier research I did on the PPP program, where we saw that among the top 5 lenders in California, 2 of them were actually exclusively online lenders. Finally, when we asked businesses to tell us what sorts of challenges they expected to have over the next 12 months as a result of COVID-19, the most prevalent concern in California was weak demand for products and services, but it was followed very closely by government mandated restrictions or closures. So again, they're sort of saying, look, the problems we've been having over the last year are still the ones that we're concerned about having over the next year. But it's interesting too that 42% of firms are concerned about credit availability. So they're looking towards meeting their current needs or being able to adapt and respond to PPP and are concerned about the access to credit. So I'm going to pivot now to looking at data on firms owned by people of color. And again, this is all from the national data. The survey has consistently found that firms of color are more likely to report financial challenges than white-owned firms. So while there was a large spike that you can see in this slide for financial challenges among white-owned firms, firms of color remain more likely to be reporting financial challenges. And the survey reveals that the financial condition of firms varies a lot by race and ethnicity. Close to 80% of Asian-owned firms were reporting that their business was in poor or fair financial condition, trailed closely by 77% of Black-owned firms. Hispanic-owned firms were doing a little bit better, but are still in worse financial condition at the time of the survey than white-owned firms. Black-owned firms are most likely to seek financing. This was true in the previous 12 months to the survey, but it's worth noting that this is also a finding that's consistent across previous small business credit survey periods. Now, again, before turning to the firms that are applying for financing, it's interesting to look at why firms decide not to use to apply for financing. And again, this is financing absent. This is not around the pandemic relief, but just sort of more traditional bank or non-bank financing programs. And among firms that did not apply, there's really interesting differences by race and ethnicity. White-owned businesses most commonly say they didn't apply for financing because they had enough financing. While firms of color are more likely to say that they're not applying because they're discouraged or they're debt averse or they thought that the cost of credit would be too high. Then when we look at firms that are receiving financing, we can see that firms of color are less likely to receive all of the financing they sought relative to white-owned firms. Black-owned firms were a third as likely to receive all of the financing they were looking for relative to white firms, and Hispanic-owned businesses were half as likely to succeed relative to white firms. These gaps persist even when we split out low credit risk versus medium and high credit risk firms. So you can see here in the green bars, among low risk firms, Black and Hispanic owned firms were half as likely as low risk white firms to receive all of the financing that they were looking for. When we look at the medium and high risk firms, we can see that 21% of the white businesses received all of the financing they were looking for, which is not significantly different than what we see for the low risk Black and Hispanic firms. I want to turn now to looking at the pandemic relief programs. We can see on this slide, firms of color are often less likely to apply to the PPP program, which was the most popular program last year. However, as we can see in the bars on the left, Black and Hispanic owned firms noticeably lagged white owned businesses in the share of businesses that applied to PPP. And in fact, Black owned businesses were as likely to apply for SBA EIDL loans as they were to apply for PPP loans. You can see that Hispanic and Black owned firms were less likely to apply to any kind of emergency assistance funding. Now here we're looking again at how how much of the financing they were able to get through PPP. And so the blue bars are going to look the same as the first set of bars on the previous slide. On the green bars, we're seeing again that firms of color are less likely to receive all of the PPP funding that they sought, mirroring trends in traditional funding programs. Most notably, less than half of Black firms got all of the PPP funding that they were looking for. And Asian and Hispanic owned firms also lagged white firms in getting all of the funding. When we turn to look at the firms that chose not to apply for PPP, the blue bars here are for all employer firms. The orange bars are for firms owned by people of color. Like we saw for California, the most common response is that businesses were worried that they wouldn't qualify for a loan or that they wouldn't qualify for the forgiveness. But when we focus on the orange bars, even though that's still the most common response, we can see important differences. Firms of color were more than twice as likely than the average firm to say that they missed the deadline for the program or just didn't know about the program overall. And in all, firms of color were less likely to apply for PPP despite needing it. In this final slide, I'm focusing on the pandemic-related challenges that they were anticipating over the next 12 months. And this slide's a little bit different than the one that I showed for California because it's reporting on the single most important challenge, whereas my previous slide let them select multiple challenges as pertinent to their business. And you can see that along all firms, issues surrounding demand for products and services are top of mind, followed by government-mandated restrictions and concerns around credit availability. But we see important variation when we look at the race and ethnicity of the business owners. Asian firms are most overwhelmingly identify demand for products and services as their #1 concern. White firms did as well, but were a little bit more likely to be concerned around government mandates. On the bottom of the slide, we see that Hispanic-owned firms are more concerned about credit availability than Asian and white-owned firms. And for Black-owned businesses, credit availability is the top pandemic-related issue that they're expecting to have over the next 12 months. So I recognize that that was a ton of data and a lot of charts in a very short period of time. For more information, you can go to fedsmallbusiness.org. There's the 3 reports that are listed on this slide that have all of the charts you could ever want on this topic. They also have reports from previous years. There's the individual data files if you want to pull this data and make your own charts, and the questionnaires are also available. The San Francisco Fed is in the process of developing state profiles, so the charts that I shared about California will be published on the San Francisco Fed website in the coming weeks. I'll be sure to share those with Emily as soon as they're live so that she can send them out to the group. And as I mentioned, the 2021 survey is live. Emily should be able to share these slides with you all. And if you want to share this individual slide with any business owners who you think might be interested in taking the survey, it'd be great to hear their voices and hear how they're doing. And finally, before I turn to questions, I just want to note 2 free webinar-based events that the Fed is hosting on October 7th. The team that puts together the small business credit survey out of Cleveland is hosting with some of their partners an event through Connecting Communities on the stats and story behind small businesses' journey through COVID-19. And on October 14th, the San Francisco Fed is having an equitable access to small business credit event. We'll be hearing from representatives from borrowers, from researchers, and from lenders in talking about access to small business credit. So I encourage you to join those events if you're interested. And with that, I can stop the screen share.
Thank you, Rocio. Who has some questions? If you could raise your hand on the Zoom. Any questions? I mean, the
Hi.
data, oh, sorry, go right ahead.
Hi, thanks for the presentation, Rocio. Really comprehensive. I may have missed this, but can you tell me how many respondents there were to the survey?
Yes, so there's almost 10,000 employer firms in the national data, and there's like 354 in the California data.
Okay, so that really California is really a much smaller percentage of the overall number of respondents.
Yeah, that's right. And Cameo is one of our partner organizations, and that's why I encourage you all to share that slide and get it out to any, small business owners, less than 500 employees. Like I said, I didn't share any data today on non-employer businesses because that data we don't have at the state level. But non-employer businesses are also welcome to fill out the survey, and it's always great. The more data we have, the more breakouts we can do for different types of business owners.
Can I just ask one follow-up question then? Which state was the most significantly represented of the respondents?
I don't know offhand. I can make a note to look it up, but I don't know offhand.
Okay, thanks so much.
And it looks like Layla Roberts has a question as well.
Thank you so much, Rocio. This is an incredibly helpful analysis, and I can't believe I'm only just finding out about its existence. Purely selfishly, we are going to be pushing this out to the rural businesses in our community because we're concerned with gaps in access and support. And by any chance, will the results be disaggregable by county or by zip code in the future?
So I suspect they will not be disaggregated below the state level. We just don't have enough responses. The published survey results, which are where I drew the California slides, actually I don't even have access to the individual questions. I just have access to like the shares broken out for each question. And I think it's just a data privacy issue. We just don't have enough respondents. You may only have like one respondent in a rural county, and we don't want to risk exposing who they are. It could change, I guess, if we get like astronomical response rates. I can't speak for the survey is run out of the Cleveland Fed, so I can't speak for sure to their methodology. But there is, however, I will say at the national level, there is some breakouts between urban and rural respondents. So you're not going to be able to get that for California rural communities, but we can see how rural businesses overall are doing in the survey results.
And Heidi, you have a question or something to add? Oh, you're on mute.
Thought I unmuted myself. I wanted to ask, is there anything, yeah, first of all, I want to say what everybody else is saying. Yes, this research is fantastic. Second, is there anything we can say about the patterns by race in California, or would that be, we can't really say, there's nothing, they don't necessarily.
The national survey team does not provide race breakouts by state.
Yeah, so, okay. And I knew that, but I thought maybe we could say something. Okay, and then I just popped in to link the survey that you can all share with your clients to take the next small business credit survey. It's like, this is the great stuff that comes out. And if we can get more California businesses to take it, we can say more about them, right? And answer some of these questions.
Lena, I was able to look up the state with the most respondents is Florida. They had like almost four times the responses that California did, followed by New Jersey. So I think it's all about just getting it out as much as we can to all our partners and hearing from as many California businesses as we can.
All right, any other questions? I don't see any other hands up, but please unmute yourself if you had a question at this moment. And all right, well, Rocio, thank you so much. What we're going to do now is we're going to move into some small groups and breakout rooms. And kind of given what we've heard from our speakers today and the data, we're going to think through a couple topics, and we're going to ask you, you'll be in groups of about 6 people, and we'll have about 8 minutes in these breakout sessions.